Hi, everyone. This is Ben Jackson with the IPA. Thank you all for joining us today. We are excited to be here with you all and to present this information on brokered deposits. As a reminder, we are recording today's call and webinar, and the recording has started. Certainly, if you have colleagues or contacts or others who you think need to know this information, we encourage you to have them review the recording at our website. We will be taking questions at the end, so as you think about those, jot them down or put them into the chat function. And with that, I am going to turn it over to our CEO, Brian Tate, to do introductions and get things started. Brian?
Sure. Good afternoon, everyone. My name is Brian Tate. Thank you for joining us this afternoon. I'm the President and CEO of the Innovative Payments Association. And again, thank you for joining us for what we think is an important discussion that we like to start off today. During any part of today's discussion, if you have questions or comments, please feel free to utilize the chat feature here. If not, you can always email all of us. Our emails are at the end of today's presentation, but I will start off by simply just giving it to you directly, which is btate@ipa.org. We do think this is an important discussion for our members and those outside of our membership. We know that the comment period at the FDIC has recently closed. And as of today, as far as we know, there were 120 comment letters filed, which is a lot, from all parts of the banking spectrum. And this includes some big names, Goldman Sachs, Schwab, BBVA, State Street. We also know there are a number of state trade associations that have filed comments, and there are some notable names that everyone is generally familiar with, whether it's the ABA or the ICBA or SIFMA or the NFIB. There are a number of groups out there that have filed comments. And so while the broker deposit regulations go well beyond the payment space and touch all corners of banking, today's discussion will focus primarily on the impact on payments in fintech. And before we go further, though, I do want to allow my colleagues to introduce themselves, Grant Hanna and Ben Jackson, so I'll hand it back to Ben.
Thanks, Brian. And again, I'm the CEO of the IPA, and I will be talking today a little bit about some of the implications of this on the business side, and am happy to have everyone joining us here today. And let me turn it over to Grant. Grant?
Thanks, Ben. My name is Grant Hanna. I'm the Director of Government Affairs for the IPA. I am also excited to be here and be a part of this discussion. Later on in this presentation, we'll be discussing some of the legislative action on this issue and some next steps for the FDIC's NPR. So again, happy to answer any questions, any follow-up, so please send them my way. And with that, I'll hand it back over to Brian.
Great. Thank you, gentlemen, and we'll get started. Next slide, please. So before we jump in, just want to remind everyone that today's discussion is part of our Summer of Learning series, and the next item up on our schedule as part of this series will be on July 7th when we have an IPA Happy Hour, and we will hand out awards that we typically give out during our conference because of everything going on that we had to postpone. So we will be having the award ceremony on July 7th, so we hope you can join us for that. Next slide. Now, we're starting off the substance of our slide, and before we begin, this is a high-level discussion. This is not to be considered legal advice, and we do encourage those that have legal questions that apply to their specific company or situation that we urge you to go contact a law firm or a lawyer who specializes in this area to get specific answers for your specific situation. So a question we get all the time at the association is, how do we get here? How did the FDIC arrive at this point where payment products are generally considered to be brokered? At the top, we have a timeline that we put together. We won't go through every bullet here, but what's notable is that the first one is FDIC, which is a bill that was signed into law back in 1989, and this was a response to the crisis that occurred in the late 80s based off primarily the S&L situation. And in Section 29, there was an amendment to the FDIA, and there's Section 29, and in that, Congress was targeting hot money, generally coming from brokers who were using those funds to place them in financial institutions to grow them very rapidly. And the concern was that these institutions had grown so quickly that those deposits were not stable, that something needed to be done. And so what they did is they passed FREA, and it had language in there that related to brokered deposits. And we will get into more details of that later, but that was kind of where things started off for our situation. The next point is the FDIC study on core and brokered deposits, and that came out in 2011. And if you have time to go through that study, we encourage you to. But basically what that study says is that generally speaking, most prepaid products are brokered unless they can apply for, unless the primary purpose exception applies to that specific product or situation. But they did not go too far and say that the primary purpose exception was unavailable to payment products or specifically prepaid products. You may know by now there have been 3 versions of the FAQs that came out in 2015. And those FAQs are far-reaching. They don't just touch payments. But for our purposes, we will focus on the payment section. But there were 3 versions, 2 in 2015. The last one came out in 2016. And we were quick to respond back in 2015 with our own comment letter, and we did a white paper, which is available in the link included in this presentation. Next slide. Then we were very pleased in 2018 that there was an ANPR released and that we had the opportunity as an industry to comment on that. That meant that the FDIC was at least listening to some of the arguments that we and others in the industry were making, raising concerns about the far-reaching nature of the FAQs and some of the restrictions that they place on institutions and their business partners. And then there has been further encouragement that the FDIC is slowly thinking about making changes here. And they came out, again, we commented on the ANPR, and then they came out late last year with a proposed rulemaking that we were pleased to see. It doesn't have everything that we would like in it, but it is, again, progress, especially if you look back to how far we've come since 2015. We quickly filed our comments since this was an important issue that we have been focusing on for a number of years. And then we did include a link in today's presentation to all the comments that have been filed. And again, I believe at this point there have been 120. So that is a small indication about the larger impact of this rule and how many people are looking at it. And so we thought today's conversation was timely. Next slide, please. The actual FAQs and the proposal from the FDIC. First, the meaning of brokered deposits depends on the meaning of deposit broker. And this is where the FDIC has had a lot of latitude in terms of their approach here. They have cast a wide net when it comes to defining who is and who is not a deposit broker. But generally speaking, again, this is a high-level conversation. Any deposits associated with prepaid accounts generally are considered brokered. What they have done is cast a very broad definition deposit broker, which sweeps in prepaid accounts. But then the next bullet, when we get to the primary purpose exception, that exception is defined very narrowly. And so this is where I think a lot of people have concerns, where there is a large definition and a very short exception that's rarely applied as far as we know. At least in something that we can rely on in terms of guidance or some writings from the FDIC, very limited access to the primary purpose exception. And among other things, as the last bullet points out, application of the exception depends on prior approval from the FDIC, which will generally take a facts and circumstances look at this. And it's not guaranteed that if you apply that you will get approved. Again, as far as we know, there have been very limited approvals over the years with respect to giving companies access to the primary purpose exception. The purpose of this new proposal from the FDIC, and there have been many statements from the chairman and others, but the purpose is to modernize the broker deposits regulation to reflect technological innovations. I think one of the things that we as an association and our members have been focusing on is that there are a number of new ways for people to access the banking system, and there's a number of new ways of how money flows into the system and into institutions. And so we think that this 30-year law And these provisions are a little outdated with kind of the boom that we've all experienced in technology and payments over the last couple of years. And we do congratulate the FDIC for taking a look at this. Now, the proposal itself has certain prongs of the deposit broker definition. And I think this is where a lot of people focused on their comments in terms, again, the wide net the FDIC still continues to cast for the definition. The prongs include engaged in the business of placing deposits and facilitating the placement of deposits. The key word here for us is probably facilitating. The facilitating prong is of most interest to payments and fintech companies in general, because a lot of them don't see themselves as deposit brokers. And so how that definition and how those phrases are settled by the FDIC will be important to everyone moving forward. Next slide, please. Again, diving a little bit deeper into the facilitating term, directly or indirectly sharing third-party information with an insured deposit institution, having the legal authority to close an account or move the third party's funds from one IDI to another, involvement in setting rates, fees, terms, or conditions for the deposit account, acting as an intermediary between a third party placing deposits on behalf of the depositor and an IDI other than in a purely administrative capacity, and any person acting on an intermediary between a depositor and the IDI unless acting only in administrative capacity. Now, I know that's a lot, but this is where the FDIC landed in its new proposal. If you go back to the FAQs, one thing just to point out and highlight is the fact that the FAQs do talk a lot about fees and what banks pay to third parties for those deposits. But it's also only one factor out of many that the FDIC is considering. And in fact, if you read closely enough, the FAQs also state that that you could also be considered a deposit broker even if there is no fee involved. So they do cast a very wide net again and give themselves a lot of room or latitude to define what is and what is not considered facilitating that will lead to being a deposit broker. The takeaway again of this is very broad, and the goal here by the FDIC is to cover anyone taking an active role in opening an account or exerting influence or control over that account after it is opened. So again, very wide net here. Next slide. And this is probably the kind of the key focus after you get to facilitating the exceptions that have been created by the FDIC. The primary purpose test, and they give three applications of how that a test may apply in different situations. There's the less than 25% test, there's the enabling transactions test, and other relationships test. And for our members, we focus primarily on the enabling transactions test, where an agent or nominee places 100% of its customer funds into transaction accounts at IDIs and no fees, interest or other remuneration is paid to the depositor. We do ask, the enabling test again is for those just facilitating payments. And so one of the things to think about is if there's a way to expand that test to go beyond just payments, or if there's ways to go beyond, or if you have less than 100%, but for right now, that was what was in the proposal. The other tests, again, there's the catch-all at the bottom and back at the top. There's the less than 25% test. We've had a number of conversations with companies in our membership and outside of our membership about this particular test. And I don't know if anyone's going to be taking advantage of it or not. It looks like the 25% may be a little low or a little high depending on you're talking to. So we're not sure who's going to try to take advantage of that test. And again, we didn't read it that in the comments that we've walked through. There wasn't a lot of comments focused on that particular test, but we'll see how that plays out moving forward. At the bottom of the page, we talk about the primary purpose exception. Again, this is going to play an important role throughout all of this. And the primary purpose exception category does not apply where deposits are placed to encourage savings, which we hope doesn't discourage people for trying to bring more people into the system. But as it stands now, that's where the proposal landed. And the application of any of the above exceptions require filing an application with and obtaining the prior approval of the FDIC. And we'll talk more about that in the next slide, but that bullet at the bottom is pretty much the situation where we are today. Again, as we mentioned, if you want to take advantage today of the primary purpose exception, you do have to make an application, informal or formally, to the FDIC. So it looks like they just put that in writing this time, but we'll talk about it more on the next slide. For the association's view, we rewrote that the primary purpose exception should apply as bright line test and not an application process. We think that there will be hundreds, if not thousands, of institutions and third parties applying for that exception, and we think the most efficient way is for the FDIC just to allow a bright line test, lay out the criteria. You can kind of just self-follow or self-examine at some level, but we do think this is going to be easier, even though the FDIC states in their proposal that they will do what they can to review these applications quickly. But if they're going to be overwhelmed, we're hopefully there's a process that will be put in place to handle those applications. And what we think the best way to do that is to create just a standardized baseline that everyone can follow without having to go to the FDIC first. If needed, we do state that any application process should have an objective list of criteria to be considered, should be completely transparent, and should include an appeals process. So we think if there is a criteria put in place, everyone should know what the basic rules are, know what they need to do to have their application accepted. And if you are turned down or your application is denied for any reason, there should be some kind of way to kind of self-correct and be able to resubmit and have your application reconsidered if you make the necessary changes. The primary purpose exception should also apply to savings features in an effort to, again, encourage savings, which we promote, our members promote, and that we think will be the best thing for getting more people into the system. And the impact of the FAQs, I will hand off to my colleague, Ben Jackson, but if anyone has any questions, we'll be happy to take them. Ben?
Yeah, thank you, Brian. So if we can go to the next slide. So the impact of this, and talking about why this matters so much, we've talked a lot about the banks, and this extends beyond the banks because the banks are one part of a larger value chain that is not only seen in prepaid programs, but really in most of the fintech programs that are out there. Your challenger banks, your financial aggregators, all of the different kinds of new ways for people to pay are being developed sort of on this prepaid model, as I know some of our attendees are very familiar with. And so what this means is that depending on how the FDIC ultimately defines what a brokered deposit is, it can affect not only the cost of operating those programs, but whether or not a bank might be able to even work with a company. So the FDIC, when it comes to brokered deposits, says that if you are well capitalized, you can take them. If you are adequately capitalized, you need to apply for a waiver. And if you are undercapitalized, you need to divest your brokered deposits. They need to go. It's worth noting that the FDIC has said that any institution that is under a written order or a capital directive or any other kind of condition where they might have to take capital action is considered to be not well capitalized. Now, probably they're going to end up being considered undercapitalized. But what that means is that ultimately, if a bank were to run into some kind of trouble, and if you look, the FDIC Chairwoman McWilliams gave a speech at the Brookings Institution in late 2019, where she talked about some examples of how banks in local circumstances ended up growing very quickly and having some capitalization problems. You can see where all of a sudden a fintech might suddenly find itself in need of having to find a new bank very quickly. And as our issuers certainly know, and I'm sure that our fintech attendees probably have discovered as well, it is neither easy nor quick to find an issuing bank. There are a lot of I's to be dotted and T's to be crossed. So that's one of the reasons why looking at what is and isn't brokered is so important, because if someone were to slip from well-capitalized to adequately or undercapitalized, it could become a big problem. So this is why we all need to be paying attention to how these deposits end up being classified on a bank's books. If we can go to the next slide. The other part of this is that the costs to this are very real. And so what I did was I went through and I reviewed a bunch of the comment letters and looked at the banks and how they identified the costs. And you can see on this slide from the various letters, the estimation of cost range anywhere from $120,000 a year to over $1 million. And these are just banks that commented, and they are not necessarily, as you can see, working with a fintech or prepaid provider. But we have heard from those banks that the cost to them would also be significant if the deposits that they have in connection with fintechs or with prepaid programs are considered brokered. And so what we need to think about is not only what are the costs for the banks, but obviously any vendor who has that cost will then pass it down the value chain. And ultimately, those costs will end up passed on to the individual customer who's using a product. And so having the right allocation and the right designation for the deposits that are being held in connection with any kind of a fintech or prepaid or other type of program will have effects on the cost of that program to operate and to have as a end user and end customer. If we go to the next slide. So the fintechs that commented also see risks to their relationships. And so there were a number, as Brian mentioned, that commented, Wealthfront argues it's a financial services aggregator. It needs these banks and it shouldn't be discriminated against as a third-party provider. The same thing with Credit Karma, who says these deposits are not brokered because they're controlled by the depositors, and that the proposed rule would blackball the promotion of savings through innovative bank fintech partnerships. One of the things that is at issue here is that question of hot money, right? How fast can this money move in and out of a bank? Because that could catch a bank out if a lot of dollars moved in and out of its deposits very quickly. And what we're seeing and what we know from prepaid programs and others is that many of the things that have been swept up under the category of broker deposits aren't hot money. They don't move that quickly. And so it's important to think about this not only from the perspective of cost or the perspective of availability of partners, but also the perspective recognizing what the FDIC wants to do, which is protect the safety and soundness of banks. And it is important to help the FDIC understand these are not hot money and they are not going to affect the safety and soundness. And it's also important from the customer perspective of the customers know where their money is and it's not going to move very quickly. So this is something that the customer controls as to where their deposits are held. It's an important distinction, and it's one that affects, again, the operation of these programs, whether it be fintech, whether it be digital challenger banks, or its prepaid programs up and down the value chain. Next slide. So now I want to turn it over to my colleague Grant Hanna to talk a little bit about what the next steps are in this and where do we go from here. Grant?
Thanks, Ben. Like Ben mentioned, I'm going to kick things off with talking about some next steps for the FDIC's NPR and broker deposits, which Brian talked about earlier, as well as discuss some recent congressional action on this issue. So kicking things off with next steps. As you can see, our first point on the slide, the NPR's comment period did close on June 9th, so relatively recently. So now I would say we really are in the final stages of this rulemaking process. So what comes next? The FDIC will begin now working to craft a final rule. During this time, the FDIC will likely review the comments they received from that NPR comment period, as well as receive input from internal stakeholders, and perhaps use that input to make revisions to the rule. They will then craft a final rule. It will likely have to go through some internal review processes, and then once it is finally approved, it will be published in the Federal Register with likely an effective date that is at least 30 days after its publication. So that's really just a brief rundown of where we are with this NPR. Like I mentioned, we are in the final stages, and right now it's just a matter of letting the bureaucratic and rulemaking process play out. So if we could move to the next slide. Next, I'd like to provide a rundown of what Congress has done on the issue. As you can see, there are a number of things mentioned, and this really is an issue that Congress is aware of and has been aware of, particularly when it comes to the issues that this raises for the payments industry. And I would say this is true on a bipartisan and bicameral basis. So both Democrats and Republicans are aware of it, and both members in the House and Senate are aware of it. And I will also note that this is an issue that has been a central part of IPA's advocacy on the Hill and on the regulatory side since 2015, since this issue first arose with the FAQs. As you can see in the 114th Congress, which would have been in 2016, so not long after the initial set of FAQs came out, Representative Scott Tipton, a Republican of Colorado and member of the House Financial Services Committee, did introduce the Protect Prepaid Accounts Act of 2016. And that is a piece of legislation which would have essentially put into law that prepaid funds satisfy the requirements of the primary purpose exemption and therefore made them not brokered. This bill ultimately did not move forward in the 114th Congress. But then in the next Congress, the 115th Congress, Representative Roger Williams, a Republican of Texas and also a member of the House Financial Services Committee, did introduce the Consumer Transaction Account Protection Act. This legislation would have specified that consumer transaction account deposits would not be considered brokered. So again, exempting consumer transaction accounts from broker deposits regulations. Unfortunately, that bill did not move forward in that Congress either. Also at the same time, I do want to note that Representative Scott Tipton, who I mentioned earlier, and Representative Blaine Luetkemeyer, a Republican of Missouri, who at the time was the chairman of the Financial Institutions Subcommittee of the House Financial Services Committee. He is now the ranking member as the Republicans have moved to the minority in the House. Those two members sent a letter to FDIC Chair McWilliams on this topic. At a very high level, the letter urged Chair McWilliams to revisit the FAQs and further narrow the definition of brokered deposits. So that is just a brief overview of some of the past actions in past Congresses that that members have been working on this issue. I'd like to turn now to the current Congress and some pieces of legislation that I think are important to highlight. We're in the 116th Congress right now. First off, as you can see, we have HR 907, which is a bill from Representative Darren LaHood, a Republican of Illinois. This legislation is mainly aimed at the insurance industry. Just at a basic level, it would further clarify the definition of a deposit broker and exclude from the definition those who are an exclusive agent of an insurance company or insured depository institution affiliated with an insurance company. That bill was introduced in January of 2019 and right now has not seen any further action. Next, we have the Consumer Transaction Consumer Transaction Account Protection Act. That is just a reintroduction of Representative Williams' bill from the 115th Congress. That was introduced in September of 2019 and as of now has not seen any action or has not moved further. I will note a companion was introduced in the Senate by Senator Doug Jones, who is a Democrat of Alabama. That Senate companion was introduced in December of 2019. So this is a bill I will note that we are seeing both bicameral and bipartisan support on, which is unique for some of these broker deposits bills. And then finally, more recently, in fact, the most recent, on June 15th of this year, Senator Jerry Moran introduced the Asset Growth Restriction Act. And this is a bill that takes a different approach to the issue as some of these other pieces of legislation that we've discussed. And it would strike Section 29 of the Federal Deposit Insurance Act entirely. Section 29 provides a legal framework for the broker deposits regulations. And after it strikes Section 29, it would just replace it with asset growth restrictions for troubled institutions. I will also note here that FDIC Chair McWilliams has expressed her support for this idea. Ben mentioned her speech at the Brookings Institution earlier. She first affirmed her support for this idea at that speech, and then did further reaffirm her support in testimony before the House Financial Services Committee and Senate Banking Committee last month. So that is kind of where we've been and where we are right now. Do want to provide a quick look ahead. Based off our discussions, we do know that House Democrats are aware of this issue and are perhaps interested in introducing some legislation. Different proposals have been thrown around over the past year or so and with different approaches to the issue. But the latest proposals from our discussions that we know that they're focusing on right now would be an approach that is similar to Senator Moran's bill. So something that would strike Section 29 and perhaps replace it with asset growth restrictions. So this is something we certainly will be keeping our we'll be keeping our eyes on, and we'll continue to stay involved in conversations around. So with that, let me hand it back to Brian.
Thank you, Grant. Our last slide is an addendum slide that talks about some of the op-eds that we have put out. But also at the bottom, I do want to point out that there are some additional readings that if you are inclined to go through them, I think will be relevant to this conversation, which is there are 2 advisory opinions that were given out by the FDIC a long time ago in 1994 that we think might have some relevance to this conversation in terms of providing exceptions and talking about the primary purpose exception and when it may or may not apply. And then there's General Counsel's opinion number 8, which we think is part of this conversation as well. The General Counsel opinion number 8 talks about the FDIC granting pass-through insurance to when a relationship is genuine and the deposits at the FDIC insured bank must belong to the purported owner. And they do talk about how prepaid is an access mechanism and a genuine product. And then they also talk about there's a discussion there about how money flows in, but they do not at any point say that they are brokered. So another important document to read through if you have the time to do so. We are looking at the questions here. We doesn't look like we've received any questions yet, but I do want to pause. I know that was a lot to digest in a little over 30 minutes. So I do want to see if anyone has any questions they'd like to ask me, Ben, or Grant.
And let me just say, I did get a question about the deck. Certainly email me if you want a copy of it, and we are happy to send you a deck, send you a PDF of it.
Ben, can you just remind everyone of what your email is?
Yeah, so my email is bjackson@ipa.org. Fairly easy one.
And I know we covered, again, a lot of ground today, and we could dive into this conversation more deeply and extend this another 30 minutes. But if after today you have a question for any of us, you should feel free to reach out to me, Ben, or Grant. Our emails are on the last slide of this presentation, and then we'll be happy to have a conversation with you. You may have a different angle or question that we may not have thought of. And we look to hear from you, even if you're not a member of the association. Again, these FAQs are far-reaching and reach all 4 corners of the banking universe. So there may be something we may not have thought of that we would appreciate if you could bring to our attention. But it looks like there is a question, and it says, I got here a little late to the presentation, but is there any speculation as to when a final rule may be published? And what do you think it might say? So I will attempt to tackle this, but if my colleagues want to jump in, feel free. First, under normal circumstances, rulemakings take quite a bit of time. There are a lot of going through the comments and trying to figure out what the next steps might be. With 120 comments, that is a lot of comments, and I think the FDIC is going to do their job and be very diligent here. But we're also dealing with unusual circumstances with COVID and outside factors. So under normal circumstances, I would say this rulemaking would probably come out first quarter next year at the earliest, since this is an important rulemaking. But the true answer is we're not sure right now. We aren't under normal circumstances. And so that is not clear when the rule will come out, because the FDIC, like others, is trying to get their hands around COVID and other issues. And I think this will throw off their timeline a little bit. Second, what will the final rule look like? I'm not sure anyone knows at this point, since the comment period just closed. But if history is a guide here, I would say that generally speaking, not just the FDIC, but any agency that's doing a rulemaking doesn't go too far beyond what they have proposed. So I think what you are looking at in the proposed rule is probably 75 to 85% of what will be in the final rule, and that there will be some tweaks along the way. And so, but you're looking generally at the blueprint the agency will follow when they are putting together their final thoughts and release them. So I don't know if anyone knows at this time what it'll look like, but we expect a lot of it to look like what the proposed rule has laid out.
Hey, Brian, can I just jump in here and note that
Please.
the proposed rule was first released in December of 2019 is when we first saw it, but it wasn't actually published in the Federal Register until February, I believe. And it gave a 60-day comment period, and then that was extended. So it seems like this process has been slow even from the beginning. So, I do agree with your assessment on kind of the process side of what it might look like in the future.
But that was a good question. It does create a lot of uncertainty because we've seen the proposal, but we don't know when those rules will come out, and we don't know when it will go into effect. Other questions, comments, thoughts? Well, looks like I was about to close out, but we do have one more question, it looks like. As a follow-up, could you discuss thoughts on a bright line exemption versus applications? Sure, we'll touch on that again. I know we had a previous slide on the bright line in the application. The FDIC generally is asking for those to qualify, who want to qualify for the primary purpose exception, to submit an application, and then the FDIC will review it. I don't remember the timelines exactly, but I think it was somewhere in the range of 45 to 90 days, and that they would try their best to get through all the applications and get back to people. And we think that there is a more efficient way to do this, which is for the FDIC to come out with standards and a baseline that everyone can follow. And that would be easier for the industry and easier for the FDIC. And we put that in our comment letter. And we've also asked that if there is some kind of rejection, if there is the need for an application process and you are rejected, you should be given the ability to correct and resubmit. And so we don't know which direction the FDIC is going to go in, but I know they started out with the application process. And I think I said this a little bit earlier this afternoon, which is that that is basically the process they have today. If you want to qualify for that exception, you have to reach out to the FDIC. They, I think, just put it in writing. I don't know if I recall it seeing anywhere else, but that is generally speaking the process you have to go through today. We are open for other questions, comments. We'll give another 30 seconds or so for people to type a question if they have one. But in the meantime, again, I just want to remind everyone, if you would like a copy of the deck, please reach out to Ben and he will send one off to you. And if you have a question for any of us after today's conversation, please feel free to reach out to me, Grant, or Ben. We'd be happy to take your question. This has lots of different aspects and angles that arise every day because different situations come up where they have an impact on those conversations. So it doesn't look like we're having any more questions, so I'll just pause to see if Ben, Grant have any other closing thoughts.
No, I would just say stay in touch with us as this moves forward. We will be watching it very closely, and we will be working to make sure that we get the best outcome possible for not only the banks, but the payments industry as a whole.
Yeah, I would echo what Ben has to say. This will, as I mentioned, continue to be part of the IPA's advocacy on the Hill and in front of the regulators going forward. We'll continue to keep our eye on it and, of course, keep our membership updated. And again, if anybody has any questions or needs anything from me, please feel free to contact me. My email is right there on the last slide.
Well, with that, we thank all of our guests for joining us this afternoon. We'll keep everyone updated on what's going on with the FDIC and the rulemaking. And we hope everyone is safe. Have a good afternoon and have a great weekend. Thank you, everyone.